What exactly is the underlying cause of this decline? Is it kind of, a confluence of things, or is there something ugly that we haven't pinpointed that the market is feeling?
Well, I think we probably know the primary trigger, which seemed to be the increase in U.S. interest rates. But I think what's notable about what's happened with this correction is in the same way that it was tech that led us on the way up, it's really tech that has led us on the way down. If you look at the contribution to the declines in the indices, it's primarily tech. So I think you had, fantastic gains up until the start of this at the beginning of October. In retrospect, perhaps a bit too much. Then you add a couple concerns about rates, obviously around China, and then weak PMIs in Europe. It just adds to the negative sentiment.
Okay, will it continue?
We're not calling a bottom exactly yet, but if we step back and look at the fundamental growth outlook, it really hasn't changed. We know, I don't think we're revising down at all our estimates for GDP growth in the U.S. We have to see about Europe, but by and large, it's still a positive growth environment. Inflation is still contained. We're not worried about inflation acceleration, so it should rebound.
Gary Schilling to join us in the next hour. Thrilled about that, to give us some price change wisdom. Jordan Rochester, give me wisdom on yen. If we were correlated across asset, where would yen be?
It should be much stronger, Tom, and it really hasn't followed the move in equities. And that's because FX is doing its own thing. It's very idiosyncratic right now. We had our risk-off moment in Q2. We've had the Turkey move. We've had the Italy move. Euro-Swiss was at 120. Now where we are, we're much lower. So in terms of FX to equities, the correlation wasn't as strong as you'd imagine. And that's because a lot of the macro community have already put on their late cycle dynamic China slowdown trades. Look at Aussie dollar. Look at Kiwi dollar.
Yeah.
They are firmly in a trend lower. The positioning is very short. I want to be short these currencies because I really believe in the China slowdown story, but everyone's got it on already. So there's always a positioning squeeze to be aware of. So that's why dollar yen really does stand out, because if you want yield, US is very attractive. Japan's not. If you hedge for that yield, then it's not worth any time anyway. So it's all unhedged.
So after your hour with us, you and Daniel Morris go down to Francine Lacroix's fancy Italian coffee joint down by Mansion House. And when you do that, you say, okay, what do I need to do to buy equities? As an FX guy, can you acquire shares this morning?
Well, you can, but you just need to be smart about it. So right now, with the market's narrative is late cycle. What does well in late cycle? It's value stocks. What does poorly is growth stocks. And we're seeing that already, and tech has been a big part of that. We looked at what trade wars would mean as well for equities quite a while ago, and this is a pain trade. When things are good and everyone's talking about higher growth, that is a trade that does not do well. But when it's late cycle, then you go long value and you go short growth. That's the usual typical play, and I think that's going to apply here.
Yeah, surveillance correction. The Italian fancy coffee place is Starbucks, because Al from New Jersey is in town and that's where he likes to go. Dan, let me show you our chart of the day. Now, this is basically looking at how much market value has been lost, and what we tracked is the Bloomberg World Stock Market Capitalization Index back to 2013. When can you call the end of the bull market?
Well, I think it's going to be, whether we're late cycle or how close to the end of the cycle, I think the trigger that's going to put us in more like a bear market is a U.S. recession. I mean, this is volatility a bit more than we had at the beginning of the year, but not necessarily outsized. Again, we're only not even in correction territory yet. Fundamentals are good. When we're really starting to see signs of a U.S. slowdown, then the game is completely different. But at this point, we think that's premature, and it's just, again, volatility that you would expect, unfortunately, in the equity markets.
I mean, volatility in currencies we've kind of gotten used to. Do you think as equity markets start seeing this route, currencies will stabilize somewhat?
I mean, plot dollar yen volatility versus VIX volatility for the S&P. VIX is high, dollar yen vols have done pretty much nothing. So like I said, there's a big disconnect right now. FX has had its risk-off move. Everyone's got these hedges in place already. So for it to really get worse, you're right, it needs to be a US recession, but I think we're far away from that still. I think at least another year before that becomes a realistic story.
Daniel, I want to look at the Dow chart right now. Let's bring it up. This is the Dow. John Farrell gives me grief about using the Dow. You know what? That's what we watch. SPX is a way better index, but we watch the Dow. And I'm sorry, Dan, it's an elegant chart with a lot of kisses here on the moving average that I use. Thank you, George Kleiman. Gorgeous kiss right here. I mean, it's well ordered and contained. What is establishing this trend, Daniel Morris? Is this a trend based off Fed policy?
Well, I think only indirectly. I think what's really seemed to have triggered the market are the comments that you've had. We know about Caterpillar, we know about 3M and their concerns about tariffs, rising input costs, concerns about sales. So that's all, I think, absolutely relevant for parts of the market, and you see that certainly reflected in the Dow. But if we look overall at guidance that we've had this quarter, at least until yesterday, it was actually running above average, above the long-run average, above the rate of last quarter, and above this quarter last year. So actually, guidance is positive. We've seen good earnings number, and I think at some point the market's going to realize that, and we're going to get a rebound.